Hey everybody, it's Seth, the Paul with Everything Money channel. We welcome you into the channel. As always, Paul and I are here almost every single day. Paul, we get together and talk about stocks and investing. Today, the huge news is AstraZeneca, the pharmaceutical company out of the UK, got approved for a new vaccine. And we're going to analyze the company right now. You will learn in this video the financial health of this company, not the stock price, maybe where they're going, but really by the numbers, the PE, the profit, the revenue, the shares they have. All of this, you're going to go through our 8-pillar analysis right now, and Paul's going to do it. But first, we obviously always ask for a very early thumbs up. We appreciate your time and effort watching the video. And obviously, these take a long time to make. Paul, you are in Mexico. Welcome in, my friend. You're in your Mexico home. I'm stuck here in Ohio. There's more snow. It's terrible, but how are you, my friend?
I'm wonderful. And you will be here in what, 3 days?
I can't wait. Yes, I'm flying through Houston to Manzanillo to join Paul. We'll be going live next week, live on Tuesdays and Thursdays to take your questions on YouTube. And we'll be doing lots of filming in Mexico. But first, Paul, AstraZeneca, what do you know about this company? What can you tell people?
So was it yesterday they just got approved for a new coronavirus vaccine? So of course I thought, oh, this is going to be great. The stock is going to skyrocket.
Yep.
Well, let's go take a look. Their stock is only up 0.7% today, which is kind of surprising. This is a company that's been around for a very long time. I mean, look at them. They've been public since 1993, and they're up about 11 times since 1993. So, not bad, but it's 132. Let's get into the pillars. $132 billion company. So remember, we don't look at stock price. We look at the market cap of the company because that's the number of shares multiplied by the stock price. If you wanted to buy every share out there and own the entire company, it'd be $132 billion, and that's what matters, okay? So first pillar, PE, 53. Seth, what do we think of that?
Yeah, so pillar number one, folks, is PE ratio. This is price to earnings, and we want this under 20, not 20%. We want this multiple under 20. So 50 is a little high, not as high as some crazy hype stocks, but this is definitely a little high, all right?
Yep, so that's an X there. I mean, we're not gonna, it's not in and of itself a reason to say no, because there are things that can happen that short-term might drive earnings down and therefore the PE up. But for right now, that's our first X and something to consider.
Pillar number two is profit margin, guys. We want that above 10%. Paul, I'm surprised by this profit margin.
I am too, because drug companies tend to have very high profit margins. So this is kind of surprising. Only it's an X still, barely under the 10%. But this is surprising, especially with such a high gross margin. And gross margin, everyone, is the amount of money they make on every extra dollar sold. Every unit they sell, they make about 79% of that in profit added to the bottom line. That's before all overhead, employees, buildings, all that stuff. Every unit sold, the direct costs are about 20%, and they make about 80% of that extra unit sold in profit.
Pillar number three, we want revenue growth up over the past 5 years. Go ahead.
Before we go, I want to make note. We also have a 2.8% dividend. So we want to make sure that in a dividend, as we've talked about in the past, can the company actually financially support it? Because a lot of companies will put a dividend out there temporarily and borrow money to pay it just to make people excited about the stock and buy more in it. So at 2.8% right now and 130 billion, that's roughly $4.5 billion. So let's call it $5 billion a year they got to pay just in dividends just to be able to cover their dividends. Okay, so now we'll go to the next pillar, which is revenue.
Pillar number three is revenue growth over the past 5 years. Paul, go ahead.
We have an X here, Seth, 24.7 down to 24.38. It is building back up, though. From 24.7, it's been dropping for the last, if you look at this last 10 years, Seth, 33.59 down. And the big thing about drug companies is to make sure they have a good pipeline. Clearly, they lost something here or they sold some other division off and revenue is just dropping. Maybe they lost a patent and now it's coming back up again. But in the last 5 years, it's still down over the last 5 years.
Paul, I know when you say something like that, like clearly something must have happened. We definitely get some comments below, like, why would you guys analyze this video if you don't know what's going on? But tell people why you don't actually care. I mean, you do care, but tell them your thoughts on the financials.
Guys, the 8 pillars here are to give us a general 500-foot view that then tells us what questions do we need to ask. To sit there and say, I'm going to go spend my time, the way I found best for me is I look at the financials very quickly, and it gives me an idea of what I want to do and what I want to look at and how I want to proceed on. If I went and did all the research ahead of time of where the company's doing, then I'm going to waste a lot of time because to me, it's a non-starter if the financials don't even show a good story and they don't even show a good multiple. Why would I even waste my time? And I can look at financials a lot faster than I can read 10Ks and articles and all that stuff. So If everybody sits there and criticizes and says, you don't know anything about the company, yeah, that's my goal. I want to know nothing about the company. I want to focus on the numbers first. And then after the numbers, tell me what questions to ask. Does the story of the company line up with that? Does that make sense?
Yeah, of course. Pillar number 4, guys, is profit growth. Profit growth over the past 5 years. Paul, what are we looking at?
Down 2.8 billion, 1.33. And Seth, look at this. 10 years ago, almost $10 billion in profit. Their profit's down 90% almost in the last 10 years.
This is not good, Paul.
No, it's not good. But again, in and of itself, it's not the worst story, but let's continue on.
Pillar number 5 is number of shares outstanding. This is the actual number of shares of stock that are out there, and we want this number going down, Paul.
It is going up, so another X here.
Oh, boy.
Yeah, so we have all 3 X's on the income statement, which is very rare. The shares are up slightly, but they are up in the last 5 years.
Pillar number 6 is current assets greater than current liabilities, Paul. Let's take a look.
All right, guys, so the current assets with the cash on hand, about $18 billion. Can they pay their current liabilities, which is the current bills they have in their pocket ready to pay? And the answer is no.
Uh-oh.
Yeah, so another X. The streak has continued.
Pillar number 7 is our most important one. This is free cash flow growth. We want to look at the free cash flow over the past 5 years, find an average, and this is going to drive us to what market price we think this should be worth. Also, Paul, as you described earlier, with that 2.8 dividend, we want to make sure they can afford that dividend and pay it to you. Go ahead, Paul.
Right. So remember, free cash flow, guys, the reason that's important is, unlike profit and net income can be manipulated with non-cash expenses. I won't get into that. But if I see a company made $1 billion in a year, I don't know if that's really $1 billion in cash they actually made. Free cash flow tells me how much cash was actually in their hands at the end of the year. It's cash from operations less capital expenditures. And the reason it's important is companies use that money to pay dividends, buy back shares, make acquisitions, et cetera. So I want to make sure that this number is growing as their business grows. And also that it's a way for us to look at the multiple we should be paying for the company over the currently based on their previous 5 years. So this is awful, Seth.
Uh-oh.
They went from 600 million in free cash flow 5 years ago to 500 million now. So it's an X there. And let's do their average. You ready for their average, Seth?
Yeah, just give me the middle 3. I have the first and last.
Okay, middle 3. 1.8 billion, 1.9 billion, 1.2 billion.
Divided by 5. 1.2 billion.
All right, so 1.2 billion, call it 15 times because they're dropping, they're not growing. Talking about an $18 billion company, right? And they're currently 130 billion. This is a big X.
So yeah, Paul, let me backtrack. So folks, what we did is we found the average free cash flow over the last 5 years, which is 1.2 billion. Then Paul comes up with a multiple. We have to multiply this free cash flow number times a certain number, usually 20. This will give us our projected market cap that we want to pay for the company. Then when we compare this to the actual market cap, which in this case, it's 132 billion, we can see if it's over or under priced. So Paul, why did you choose that low multiple in this stage for pillar number 8?
So this is that's the most common question we get. The reason is the multiple changes based on different story of the company. Are they growing or are they not? If they're growing, I'm going to pay a higher multiple. If they're not growing, I want to pay a lower multiple because the only way I'm going to get my return is by the company having cash being stored in their banks or giving it to me as an investor or buying back shares. So with a growing company, I can make money as the company grows because the value of the company grows. That's not happening here. So I'm going to pick a lower multiple. 15 actually might be high. This is just bad. Guys, I'm avoiding AstraZeneca at all costs. I'm not doing it. It doesn't mean it's not going to go up, but from my value perspective, I'm not touching this thing at all at $130 billion and the current stock at all. But
go ahead, Paul.
The thing I want to talk to you guys about is a biopharmaceutical company that I actually love, Biogen. Biogen is selling for 8 times earnings. 8 times earnings, guys. It's a $37 billion company. And look at this, $37 billion. And last year, it made $6 billion. So you can buy it for $37 billion, and they made $6 billion last year. AstraZeneca, you buy for $132 billion, and it made $1.3 billion last year. So you're paying 5 times more for AstraZeneca to get 60% less profit, 70% less profit. And the best part about Biogen is they have 20 drugs currently in some phase trial, phase 1, 2, or 3. 11 of them are in phase 2. 6 of them are in phase 3. Based on historical averages, based on that historical average of approvals, they should get at least 4 or 5 of those drugs approved in the next 5 years. Guys, their pipeline is insane. AstraZeneca's is garbage. We looked at AstraZeneca's pipeline. It is absolute garbage. If you're buying AstraZeneca merely because of the COVID vaccine, I think you're wasting your time. But Biogen, I'm a big fan of. I think Biogen's worth well more than what's paid for right now. It's a patience game, though. You have to be patient for it because their pipeline is incredible. It's going to take a few coming through. And they're also in areas that other people aren't tackling as much of. They're in ALS. They're in other Alzheimer's areas and dementia areas. I love Biogen, and it's a much better buy right now based on just the current financials. I mean, by the way, remember, the average free cash flow for AstraZeneca was $1.2 billion, and their dividend is $5 billion. They can't afford their dividend. Something's got to give. Either the dividend's got to give, or they're going to take on more debt to pay that dividend, which is called a dividend trap. So they're hurting you while they're trying to help you. Doesn't make any sense.
If you like what you see, guys, if you love following the math of these companies and not the hype, again, we implore you. The AstraZeneca's in the news, and some people may say it's a buy. They're on the upswing, but their financials are crazy. So we implore you, let's find a company like Biogen that's not so much undervalued, but it just has way more profit, right?
I do think it's undervalued, by the way.
Oh, really?
I think I'm acquiring shares of Biogen right now.
Yeah, now, Paul, remember, this Biogen is on the list from the little book that beats the market, which I follow.
Oh, that's right.
Yeah, so I bought Biogen back in July 1st. I bought $5,000 worth of it. So, yeah, that's great. Guys, if you love what you see, make sure you tickle that like button. Paul loves getting tickled, so we'd appreciate that. As always, we appreciate it. Subscribe. And, of course, Paul, we cannot not mention our Patreon page. Our Patreon is growing like cats and dogs. No, it's raining like cats and dogs. So, but either way, the Patreon is absolutely incredible. Paul, I don't think it's been 2 months. Maybe tomorrow will be 2 months, and we have almost 150 members in there. You get access to our Discord channel. You will talk to Paul, learn his investments, his trades, his options, his portfolio. Mine as well. Not as flashy. I'm a kind of a normal person, but we will also do Patreon-only live stream, uncensored live streams, which we'll be doing one next week in Mexico. Paul, what do you think about Patreon?
And we're making the Everything Money website, 8-pillar website. So instead of asking me, you can go to the 8 pillars. You can input the stock. It'll give you all the 8 pillars immediately and all the financials that I pull up, all for $25 a month. But guess what? If you're a Patreon, you get it for free. So sign up. Doesn't matter what level you are in the Patreon. You get the website for free as long as you're a Patreon member when it comes out. Don't wait until the website comes out, because I'm going to change the Patreons the second the website comes out, because I want to reward people who invested in us early.
If you like what you see, scroll through our videos we've done. Paul and I have been doing this relentlessly for 2 years, and we've looked at 1,000 companies, and we welcome you to scroll around and take a look. Thanks, Paul, for your analysis, and thanks for watching, guys. We love you. Appreciate it.
Thank you, Uncle Seth.